Welcome to Windfall Edutech Intermediate Module. Chapters. Chapter 1. Valuation and its importance. Chapter 2. Fundamental Analysis. Chapter 3. Technical Analysis. Chapter 4. Economy and Equity Market, the Correlation. Chapter 5. FII and their role in Indian equity market. Chapter 1. Valuation and its importance. What is valuation? Valuation-Two extreme views. 3 approaches to valuation. Discounted cash flow, DCF. Advantages of DCF. Disadvantages. 3 ways of classifying DCF model. Free cash flow to firm, FCFF. Free cash flow to equity, FCFE. Discount rate, WACC. Relative valuation. What is valuation? Valuation is the process of determining the current worth or potential market value of a company. Some assets are easier to value than others. Also, the details of valuation may vary from asset to asset. The main aim for any investor is not to pay more for an asset than its actual worth. Valuation-Two extreme views. On one end, there are those who feel that valuation is a hard science and has little scope for analyst views or human error. On other end, there are those who believe that valuation is a sort of art, where the analyst can play with the number to generate whatever result they want. Main purpose of stock exchange is to aid in exchange of securities between buyers and sellers. 3 approaches to valuation. Absolute. Discounted cash flow valuation is an absolute valuation model which relates the value of an asset to present value of expected future cash flows of the asset. Relative valuation. Relative valuation estimates the value of an asset by looking at the pricing of comparable assets relative to common variables such as earnings, cash flow, book value, sales, etc. Contingent claim valuation. Option pricing models are used to measure the value of assets that share option characteristics. Discounted cash flow, DCF. DCF is the most popular method used vastly all across the world and comes with the best theoretical credentials. Implies that value of asset as of now is the sum of all its future cash flows which are discounted to present value. Cash flows are discounted back at the rate that reflects the riskiness of these cash flows. Cash flows in case of DCF analysis shall vary from asset to asset. Dividend for stocks, coupon and face value for bonds, cash flows after tax for business. Discount rate reflects the riskiness of cash flows. Higher the risk, higher the discount rate, and lower the risk, lower the discount rate. Equity being a riskier asset will have a higher discount rate vis-a-vis the debt. Advantages of DCF. DCF analysis entails the analyst to understand the minutest details about the business that they are valuing and come up with queries about the sustainability of cash flows and the risk. DCF valuation goes perfectly with the Warren Buffet's set of beliefs. As per Warren Buffett, we do not buy the stocks but the underlying business, which is perfectly in sync with DCF valuation process. DCF model is considered to be contrarian in its approach, as it forces the analyst to dig into fundamentals of company rather than market perception or sentiments. In case if the rise in stock price is disproportionately relative to underlying earnings and cash flows, DCF will find the stocks overvalued. If the stock price fall disproportionately relative to earnings and cash flows, DCF will find the stock undervalued. Disadvantages of DCF. If the analyst is sloppy or careless, DCF model will generate results that have absolutely no connection to the intrinsic value of the company. There is loads of bulk information that is required to value the company in case of DCF models, which might make it a tedious and time-consuming task in itself. Also, in a scenario where the market perceptions of the stock have run way above its actual fundamentals, DCF valuation model will find all the stocks undervalued. 3 ways of classifying DCF models. They are, going concern versus asset valuation, equity valuation versus firm valuation, DCF model variance. Going concern versus asset valuation. Balance sheet of the company gives a correct picture for drawing out the differences between valuing a business as growing concern and valuing it as collection of assets. In a going concern valuation, we have to estimate not only the existing investment, but also the future investments and profitability. In the case of asset-based valuation, the main core area to be looked at is the assets that are in place and estimate the value of each asset individually. Equity valuation versus firm valuation. There are two ways in which we can approach the DCF valuation, that is, to value the entire business, or to value the equity stake in the business. Valuing the entire business is called as enterprise valuation, and the cash flows used in this valuation are called as FCFF, free cash flows to the firm. Whereas, cash flows used while valuing the equity of the firm, that is, equity valuation, and it is called as FCFE, free cash flows to equity. Variations on discounted cash flow models. There are two widely used variants of DCF approach. For the first variant, cash flows are divided into excess return cash flows and normal return. Earning a risk-adjusted required return is termed as normal cash flows. Cash flows in excess or less than that are considered excess returns. Excess returns can, thus, be either positive or negative. Value of business equals capital invested in firm today plus present value of excess return cash flows from existing and future projects. Second variant is called as adjusted present value approach, APV. APV separates the effects on value of debt financing from the value of assets of business. Usage of debt to fund firms' operations creates tax benefits on positive side and increases bankruptcy risk on the negative side. Value of firm equals value of business with 100% equity financing plus present value of expected tax benefits minus expected bankruptcy cost. Free cash flow to firm, FCFF. FCFF is a measure of company's financial performance or profitability after all the expenses and reinvestments. Positive value would indicate idle cash left to the company's disposal after paying off all the expenses. Negative value shall indicate that revenue of the company has been unable to cover its cost in that particular year. FCFF is an important tool to stockholders. FCFF is based on the thinking that, to earn revenue, a firm needs to incur operating expenses, invest in real estate, buildings, equipment and working capital to support its business activities. In addition, company must pay the income tax on its earnings. Most of the investors prefer to use free cash flows to measure company's performance versus the net income, due to the difficult nature of FCFF, which makes it more difficult to manipulate as compared to net income. Free cash flow to equity, FCFE. FCFE is a measure of cash left over for the company's shareholders after accounting for all the expenses, reinvestment and debt repayment. FCFE is considered as an ideal alternative to dividend discount model, DDM. FCFE model is used by analysts to determine the value of the company. Discount rate, WACC. Cash flows are discounted back at the rate that reflects the riskiness of these cash flows. Weighted average cost of capital, WACC, is highly used by the businesses as the discount rate. WACC is a rate that the company is expected to pay on an average to all its stockholders for financing its assets. All capital items, namely common stock, preferred stock, bonds, long-term debt, are included in calculation of WACC. WACC is the average cost of financing sources, each of which is assigned a weight. Many a times managers of the company use WACC to determine the economic feasibility of the company with regards to mergers and other expansion opportunities. Cost of debt is nothing but the rate of interest paid on debt. Thus, in order to calculate the cost of debt, after-tax cost of debt needs to be taken as interest to company as a tax-deductible expense. Cost of equity is equal to risk-free rate of return plus premium expected for risk. For calculation of expected return, CAPM model is widely used. Relative valuation. Relative valuation compares a stock's valuation with those of other stocks or with the company's own historical valuations. Relative valuation compares a stock's valuation with those of other stocks, or with the company's own historical valuations. It is an easy method of finding out low-priced company with strong fundamentals. There is a three-step method of doing relative valuation. First, compile list of comparable peer firms and determine their market value. Second, market values found out should be converted into comparable trading multiples such as PE, price-to-book ratio, enterprise multiple. Third, companies' multiples are compared with those of its peers to evaluate whether the firm is overvalued or undervalued. In order to effectively use relative valuation for valuing the companies, it is essential that the investors be extra cautious with regards to picking up the comparable firms. Investors should be in a position to find out that whether a company deserves higher or lower multiple versus its peers. In order to use relative valuation effectively, it is very important to use relative valuation in conjunction with other valuation methods such as DCF. Thank you. Revise and get ready for the next